Hi, this is Kevin Matras, and welcome to the Zacks Ultimate Strategy session. As you can see, this month's episode looks a little bit different from the others, as we are all doing our parts from home rather than the studio. But while it may look a little bit different this time, everything else is the same. We hope to get back to normal for May session, but in the meantime, we hope you enjoy this one.
Hello, I'm Jeremy Mullen, and I've got today's market conditions on the technical side, today's technical view. Let's get to it. We're looking at the S&P 500 cash market, the SPX here, and basically what I want to show you is the channel that we were in for the last year, basically. We broke up to the highs around 3,400, and then the mighty COVID hit us, and we have just tanked since. There was no real support at any moving averages. The news was just too negative, and we came all the way down to 2,200 before bouncing to this 21-day moving average, which is the green line. Today, we actually have a broken trend, and we're above it, so that's very good news. But I wanted to go over both the negative scenario and positive scenarios I'm seeing. First, we'll start with the negative. For you people that are really scared and really bearish, you're going to love this. Looking back to 2018, we had this trend line of resistance, and I had this drawn down as possible support in the future. And little did I know that it would come right to it. Basically, I had a 61.8% resistance that broke. A Fibonacci from here to here broke, which filled this 161.8 that lined up with this trend line. We bounced aggressively from there. And now we have the same kind of setup. From lows to highs drawn, we have the 61.8 that broke. There was no support whatsoever. Down to 2,200. And now we have this ridiculous price target down at 1,600 along with this support downward trend line. Now, I'm not saying that we're going to hit this. This would probably be a worst case scenario. The virus continues to spread, lots of people dying, economic damage, shutdowns continue. So this is your worst case scenario. I'm not saying this is going to happen, but it is possible. Looking at the NASDAQ, we see the same setup, ugly, ugly, ugly setup with potential for stocks to go much, much lower. I'm not saying this is going to happen, but this is your worst case potential. Looking at what I think is more likely going to happen, we have, once again, the S&P 500 futures chart, 2,200, we bounced, and we came to this 21-day moving average. We are now above it. Today, we had actually a move above 2,600, which is great. I'm looking for this to consolidate above the 2,100 or 21-day and move higher. Hopefully, we can get up to the 50-day or a 50% retracement of this Fibonacci from highs to lows, and perhaps we can even get to 2,900, which would line up with the 50-day moving average. So we'll see. We need some positive momentum higher. We need the coronavirus to stop spreading. We need Europe to slow down spreads. We need New York to slow down. We need a lot of positive things can happen. And perhaps we can shoot higher into earnings season and see where we are economically. That's more of a fundamental aspect that's going to control this market. But I think technically we can get up into this area between 28 and 2,900 and then see where we are. This is a significant move higher, but it is possible. Looking at an individual stock in Apple, I want to show you guys how these fibs work. Lows from 2018 to highs. Look at where we went. We went right to the tick of the 61.8% retracement. Now, normally I would say we're in a position to go higher and eventually touch this macro price target with 70. However, in this environment, I'm not sure if it's possible. I wanted to kind of show you a more realistic option. From lows, or from highs to lows here, we had a 61.8% test that filled. So I'm drawing from these highs to these lows. We see at 270 will be a significant area for Apple to come into and test. Between the 50-day moving average and here, if you're long and looking to get out, that's where I would look to take some off. This will be a big test for the market as well in this area. If the market continues to weaken, I have 191 price targets for Apple. So be careful in here. There's a lot of scenarios that could play out, both long and short. And if we go back to the original chart of the S&P 500, there's just going to be a lot of volatility in this window. And I can see us forming a big trading range over the next 6 months into the end of the year. So with this volatility, the technical picture is not clear. But for now, short term, we are bullish. Longer term, likely bearish. So take that into consideration as you go forward. I am Jeremy Mullen, and this is your technical trade or technical market view. Have a good day.
Hi, this is Sheraz Mian with a fundamental overview of the stock market. We are living in extraordinary times, and this discussion is critical for all of us to get a sense of where we are. So I'll present my ideas in a bull bear framework as I have done in the past. So let's jump right into it. I have these slides put together. And let's start with the bull side of the argument. As you could see here, the top argument is that the economic downturn, the coming recession that everybody's talking about, has been deliberately engineered by the government as a way to freeze the pandemic. The economy, as we all know, was in excellent shape before the downturn, and odds remain high it'll spring back fast given all the pent-up demand. The unemployment rate was at a 50-year low, as we knew ahead of time. The unprecedented fiscal and monetary support, the fiscal side of the rescue package is equivalent to 10% of the GDP, literally a bazooka, if any was there. And valuation has become attractive. And in the next slide, we jump a little bit into the valuation question. As you could see here, I'm looking at the trailing 12-month PE, and I'm using the trailing version of this metric deliberately because the forward-looking version is a little bit hazy. And it's reasonable to be a little bit skeptical about estimates for the next 12 months. So you could see here about 15 and a half times trailing 12 months. And I've extended that to where it was last time. And that's around where we were in 2013. So essentially, 7 years worth of multiple expansion has been squeezed out of the market. Which suggests to me that the bulk of the sell-off is behind us now. Even if we are not at the bottom, we are darn close to that side. So let's go to the bearish side. The top argument here is that the economic downturn is primarily a function of the underlying public health issue, and as long as that remains uncertain, it's hard to be confident in any way and have any visibility about the economic side. The market is pricing a best case scenario with the lockdowns, duration, and economic impact. The consensus view is that we peak in the outbreak in a mid-May time frame and go downhill in terms of infection rates and get over the whole thing by late summer. And the argument here is that that's a best case scenario. It is possible that we are not done with this outbreak and we get the cycle revived in the fall, and that will drive the downturn in the economy and will not be confined to just 2 quarters. Then the next point is that some key industries, particularly leisure, hospitality, aviation, retail, and energy, are so badly hit that to expect these spaces to bounce back will be too optimistic. And then the bears also take a point with the valuation argument, and we get into the detail here in this slide. And as you could see, the current downturn is about 21%. The current contraction in the trailing 12-month multiple. And the bears say that the one we experienced in the fall of 2018 was about 28, 29%. The one we experienced in 2010, 11 was north of 40%. And the one ahead of the great financial crisis was 35, 37%. So the point here is that the downturn and the contraction that we have seen in the multiple is just not big enough. And we may need to go down as much as we saw in 2010 or 11, or maybe even ahead of the previous recession. Let's sum it up. And my view here is that the outbreak is undoubtedly a huge setback of historical proportions. But we entered the downturn in excellent condition, and given the engineered nature of this economic recession, we should be in good condition to come out of it once the underlying healthcare issue is resolved. On the valuation front, I acknowledge what the bears say, but we don't need to go down as much as we did previously because this isn't a structural issue in the economy which gave us the downturn. I strongly feel that for long-term investors, they should just stop looking at their outlook over the next few months. Look beyond 2020, irrespective of whether the best case or the worst case unfolds. 2020 is washed out, and we know that we'll come out of it at the other end in good shape. Many industries and companies have the financial flexibility and strength to come out even stronger. And many of those companies are selling at 20, 25, 30% discounts relative to where they were just a few weeks back. So for folks who have a long-term holding horizon, I think it's an excellent opportunity. You start dipping your toes in the market. Don't jump all in at once, but start making small positions, and that should put you in excellent condition as far as this market condition is concerned.
Sheraz, Mian, and Kevin Cook try to agree to disagree right after this list of recent Zacks Ultimate top movers.
Time for Agree to Disagree. And Sheraz and I are doing this segment. We don't have big issues to disagree about, but there's, the scenarios are so wide right now and the tails are so fat that there's a lot of things we need to consider. I mean, you have to give downside probability in the economy and earnings in the stock market. You have to give that a bigger weighting because of what's possible. And we don't know the full impact. So there's a lot of, not just waiting for data, but to see when the virus peaks and when the economic data, say unemployment peaks. All right, so I'm going to give you my 3 reasons to be optimistic right now, and then some of my concerns. All right, so I'm going to share my screen here. Hopefully you see 3 reasons for optimism. Facts, not hope. All right, let's just jump right in. The first big reason for optimism is what this is doing for healthcare globally and in the United States. So I'm just calling it healthcare and zoonotic preparedness. And zoonotic, as you may or may not know, is, diseases that can come from animals. So that's how we describe something like SARS or something like coronavirus, of which there are several coronaviruses. Now we've got a novel one. Back in 2009, the NASEM is the National Academy of Sciences Engineering. They had a global conference where they talked about what do we need to be watching here. So it was titled Sustaining Global Surveillance and Response to Emerging Zoonotic Diseases. I can show you that here. If you just search it, National Academy of Sciences, Engineering, and Medicine, you just put in this title, Sustaining Global Surveillance, you'll find that this publication from 2009. So many scientists and medical researchers were on top of this and realizing that we needed to have a global response to potential pandemics. Here they're talking about H1N1, swine flu, SARS, mad cow disease, HIV, and AIDS are all examples of zoonotic diseases. And, having global surveillance systems, they were looking at how do we improve that. So even though we had this knowledge in 2009, we weren't ready. I think we're going to be better prepared. Here was one factoid from that presentation. Of 1,400 known pathogens that infect humans, more than 800 are zoonotic. So the healthcare industry and government has work to do in our preparedness. So that's a good thing that's going to come out of this. There's that again. All right, number 2, civilization and crisis. Look at in the past 100 years, all the crises that civilization has survived. World War I, the Spanish flu, which killed anywhere from 50 to 100 million people. World War II, U.S. excursions abroad that killed many and may or may not have been worth the life lost. And then the great financial crisis. Civilization survives crises. I think we all know that. It is a reason for optimism. It's the pattern of history. That's a fact, not an opinion. All right. Number 3 reason for optimism, that we have a global economy that is built on technology and services now. And what's different now is how quickly that sort of just-in-time economy could rebound. So it's much more agile now. So the wild card surprise might be how fast it rebounds. Then we talk about my biggest concern is how fast or slow do the jobs come back. Right now we can say the financial plumbing will be fine. The stock market is functioning, but 15 to 20% unemployment probably won't reverse quickly. And we have to think about, could there be semi-permanent shifts in how a small and medium-sized firm adapts into Q3? And the way to think about this question is, if you own a small business or medium-sized business, anywhere from 25 to 100 employees, have you adapted in such a way that you are downsizing and you may not do any more hiring this year? You've adapted to the shutdown, so to speak, and so does that make full hiring come back more slowly into Q3? That's a big unknown. That's sort of the negative wild card. UBS posted a thing on Twitter the other day, one of their economists, and he wanted to make a note. Hey, watch the survey data you're getting, whether it's PMI, ISM, or even unemployment, because the surveys are being impacted with smaller samples and lower quality. So that affects any kind of sentiment or confidence survey. John Blank highlighted the Federal Reserve Bank of Atlanta recently for their survey of business uncertainty. I think everybody should go there. Here's the page right here. So FRB Atlanta, you could just search survey of business uncertainty. I like this because this data goes back to January of 2015. So it gives you a quick visual snapshot of that earnings recession that we had for 2015 and 2016 and how the data compares right now. So you've got business expectations, business uncertainty. Here's the one that John Blank has highlighted recently in his research. He published a report, I believe, last week. Definitely look for that. And here we have business expectations collapsing and business uncertainty spiking higher. So use this FRB Atlanta page for that and keep an eye on that. All right. Back to my slide deck here. So another angle on the consumer being laid off. What does it do to consumer credit? This is from Hedgeye Research. Every million incremental gain in continued claims, jobless claims, results in charge-off rates rising by 1.7%. Basically, banks having to, or credit card companies writing off consumer debt. And so look how quickly we jumped. In 2 weeks of claims going up to 10 million, we climbed to 19% potential charge-offs in 2 weeks. And they note, for comparison, at the peak of the financial crisis, 08-09, charge-off rates only reached 10.5%. They say it's moving so fast, most people don't have a framework for contextualizing how epic these numbers are, unquote, versus something like emergency savings, which we know are negligible. A large majority of households don't even have $400 saved for an emergency. And they're only getting a $1,200 check as far as we know right now. And what about small businesses? What kind of cushion does a small business have? A restaurant, other small businesses. So another sort of wild card to the downside we need to think about. All right. So other than the jobs and the consumer side, two areas to watch in April that I think will speak to the larger economy. One, how fast are China and Korea coming back online? Since South Korea appeared to handle their healthcare crisis pretty well. How fast do the supply chains restart there? And then the other thing is earnings warning season is coming up, right? We're going to hear companies are already pulling guidance. Hey, what we told you a month ago or 2 months ago, that guidance no longer applies, and maybe they're not giving any guidance. So we're going to start to see the earnings warnings come. So, and then what we want to listen to, what are companies saying about their operations, staffing, capacity, supply chains, etc. All right, I gave you this scenarios and probabilities map on March 31st. We're still in the relief rally phase where we have an 80% chance in April of the lows holding at S&P 2200. Right now we've got, obviously, there's a rally on Monday. We've got legs to go higher above 2700. But it's going to be volatile. And I think this is going to swing on emotion where everybody who got really worried, now the stock market climbs higher, forces them to chase. And then when no one's too worried about the economic data or earnings data, then we go lower again and come down and test the lows. All right. So next up, Sheraz is going to give his take on the economic and earnings impacts of this crisis and their duration. I think he's also going to consider what a worst case scenario might look like and assign a realistic probability to that. So thanks for joining me, and feel free to email us or pay attention to the commentary. Obviously, I've been talking about this in Taser day by day, trying to game this economic downturn and how we can trade the market in the meantime. All right, next up, Sheraz.
Thanks, Kevin. I don't necessarily disagree with Kevin's base case. I think it's reasonable to expect the worst to be concentrated in Q2 with a recovery process getting underway in Q3. But I do feel that we should have an opinion on the worst case scenario. And what I mean by the worst case is the outbreak extending towards the end of the year, perhaps continuing into the new year, which obviously has implications for the economic damage, how the market performs, and obviously the eventual recovery. I don't think I would assign more than 15% probability to that view, which itself obviously is a subjective. My personal opinion. You guys could agree or disagree with that. The base case remains with the full extent of the damage getting confined to Q2, with GDP declines anywhere from 10-15% at the low end. That's on a quarter-over-quarter basis to as much as double that level. That has implications for corporate earnings, which are already at double-digit levels, both for Q2 and Q3. But the economy should start recovering in a fairly robust phase in Q3, which should continue in Q4 and continue into the new year. The market, since it's a forward-looking pricing system, will have turned around ahead of that. Meaning that the roller coaster behavior that we've been experiencing in recent days should continue through most of Q2, though as we see more visibility on the infection curves, should give greater direction to the market. And as I explained in the fundamental overview, the market and the valuation multiples do not need to contract as much as we have seen in prior downturns, primarily because of the engineered and artificial nature of this downturn. Let's not forget, we got into this downturn through forceful government action, which took big chunks of the economy offline. And as those conditions change, the economy, which was in pretty good shape ahead of this issue, should come back real strong. So my base case, just to repeat, concentrated in Q2, a little bit in Q3, but a strong recovery that then continues towards the end of the year and into 2021, and some probabilities for a worst case scenario as well.
Ahead of the Zacks mailbag, here's this list of recent Zacks Ultimate new additions.
This is Sheraz Mian with the Portfolio Makeover segment. This month's submissions were significantly more than we are typically used to, and Kevin Cook, who is joining me in this segment, suggested that we do more than the usual one or two portfolios. So to that end, I've picked up 2 portfolios, and Kevin Cook will share 4 with you guys. The 2 I picked, I've added to the Zacks.com portfolio tracker. So let me share my screen with you guys so that you could see what we have here. As you can see here, this first portfolio is from Carmelo D. And this is a portfolio that I really like for a number of reasons. Even though it is a bit on the bigger size in terms of the number of holdings, Carmelo has about 30 holdings. And even though, as you could see at the top, it has Apple and a few other of these bellwether companies, like you could see Intel is here, Microsoft is here, and 2 or 3, I want to say, other large cap companies. But on the whole, Carmelo has a beautiful blend of small to mid caps, primarily in the tech sector, but a fair amount from the healthcare as well. We obviously don't know how long Carmelo has held on to these positions. But personally, if I had a risk profile that could tolerate a little more volatility and could have an aggressive posture, I would be in the same place as Carmelo, preferably with relatively fewer holdings. I think 30 plus is on the higher side. It's get hard to manage. My preference would be somewhere in 20 or less. And that was the motivation for the second portfolio I picked here, which is from Pragati D. And you could see here, Pragati has about 17 holdings. So just the right size and the right number of holdings. One other thing that I really like about is that even though it's just 17 holdings, there is a fair amount of diversification, as you could see. There is Alibaba there, there's Chevron, there is Eaton Corp, there's Ford Motor Company, Groupon, and Micron, Occidental. So even though it may seem that 15 to 20 stocks may not lend itself to as much diversification as you would like, the reality is actually a little different, as you could see in Pragati's holdings. Again, I'm not talking about how well it has done or how well it will do, but this is sufficient diversification. It has holdings from all different sectors, and it's relatively easier to manage as well. So with that, I'll hand it over to Kevin Cook, who will share his portfolios that he has selected of ZU customers.
Hey, everybody. I'm going to look at the portfolios of 4 subscribers today and talk about some different things. Actually, we're going to look at 2 portfolios and then some questions, some very detailed questions that I think many subscribers might have. So let me share my screen here. All right. You should be seeing my, I got a slide here, portfolio makeover. And we're going to start off with Cecilia. And I want to read her letter because it has some elements in it that we want to know before we actually look at her portfolio. I have tried to diversify my portfolio. Some of the stocks were inherited last year. However, they fell in value considerably. No wonder with the flash bear market we just had. The majority were purchased mid last week and made gains between 5 and 15%. However, all the gains were erased today. I do not know if I should sell at a loss should the market continue to go lower given the volatility. All right, so some key things there. So she's basically made these buys roughly 10 days ago, we'll say, and experienced part of the big relief rally bounce that we had. And you can imagine that I have some very specific advice there. Let's look at the portfolio first. So here's Cecilia. Let me scroll down. 37 stocks. Let's try and see them all. And I really like a lot of the holdings here. When you think about if you're buying stuff on sale with the flash bear market we just had, buying AMD, buying Salesforce, Booking. I like those ideas. Salesforce is going to come out of this strong. I mean, they already have a strong online game in the cloud, and they're going to dominate, just like Microsoft. Let's see what else Cecilia has here. JP Morgan, probably good to own a stalwart bank here. Merck, I like it. Microsoft, I like it. NVIDIA, hope she followed me there and bought a couple weeks ago on the lows near 200. Some energy, and then she's got some ETFs like the technology sector ETF, staples, utilities, healthcare. Nothing wrong with owning those. So my basic take is, and this is a lot of stocks to manage, though I would say that having 37 stocks, if it's something that you you don't feel you have to actively manage, no problem. But if you're trying to stay on top of let's say 30 stocks plus ETFs, because she's got Vanguard real estate in here, it can get a little tricky. So my overall thing would be, if you bought these stocks on sale in the past couple of weeks, you're doing great. And so some of the gains were erased. The relief rally faded, but now the relief rally is still in progress. It's back. So if you're, as I believe, the economy is not going into a depression. Now is a great time to be picking stocks. All right, let's look at Marcy's portfolio. Marcy's sort of the same thing. I like a lot of things here, like Apple and Amazon. Bluebird, obviously, she followed me there. And, we could be down 30-40% there. And that's the one thing I didn't anticipate about this crisis is the disruption to clinical trials, which is going to hurt a lot of emerging biotechs, CRISPR included. They had an announcement last week. She's got Cure here, the 3 times daily bull. This is something we're just trading. We don't want to own this forever. We, see if we can make 10-15% off of it as it goes green here, as it is now. Facebook, I like it. Johnson & Johnson. Marcy also indicated that she has a significant position in Johnson & Johnson because she used to work there. And if you look at the chart of Johnson & Johnson, went down to, say, 115, 110, it's recovering really nicely. And if you listen to me in the Agree to Disagree segment, you're going to hear me talk about how one of the good pieces of news here is how healthcare has a chance to reset, reinvent itself, and prepare for, global emergencies like we're in now. So she's got some Tesla. I don't know where she owns it from, but I always wanted to buy it, near 400 anyway. So good looking portfolio there from Marcy. All right, now we're going to look at a letter from AW, and she has a special situation. Doesn't apply to everybody, but I think everybody can learn something from it. I'm going to draw some things out. So many investors will benefit from her story. Please forgive me to write you my personal information, but I thought it may help select my portfolio. I am 77, and my husband passed away in January this year. Sorry about that. In February, my total asset in stock was, we'll say, mid to low six figures, but it went down 25%. Not surprising. I was upset and did stupid buys and sells. Presently, I have the following stocks. She has very small positions in these individual stocks, so I'm not sure what's going on, but very small exposure. She's got some cash in her brokerage account. She will not need income from these stocks for 2 years. Okay, so that's good to know. And approximately so much in her checking account. Obviously, I'm hiding those amounts. Here's the real key here. I need to ensure income for a 42-year-old handicapped son after my death. I'm leaving my house for him, but there is a long-term care earning stock. I will feel more comfortable for him. Okay, so a commonality many people might have is many boomers are taking care of their parents right now. Here's a sort of flip situation where she has to worry about a handicapped son who she wants to provide for should something happen to her. This is a situation where if this person does not have a financial advisor or a financial planner, she needs to find one because she has a very special situation and she has to do a lot of planning. And so, depending on what broker you're with, you can like if you're with a Schwab or a TD, very reputable firms or a larger bulge bracket firm, you can ask them about getting a financial consultation and shop around for somebody that is reputable and that you want to talk to, because you really need somebody with some hands-on, with some excellent planning skills to help you manage this sort of situation. So that's what I want to say for AW. Okay, let's look at Neil's portfolio. Neil is a tech investor because he is he works he's a tech consultant, and as he says, so you can imagine that I like FANG stocks a lot, he says. And he sent this breakdown of his portfolio. He has a huge position percentage-wise in Shopify, which he bought in 2016. He's obviously been up over 7-8 times at the stock highs, and he's wondering if he should sell. He's got some Netflix, he's got some NVIDIA, a little bit of Microsoft he just bought, and he sold a position in Facebook that he had from 2013. So he's done really well in a lot of FANG stocks. And I like the Shopify position. He has 24% cash right now. And specifically, he's wondering, he's a little concerned. He's a little nervous. What should he do with Shopify? Listen, Shopify is going to go on sale here even more, I think. And I think that's a good thing. I think it's a long-term play you want to be nibbling on as it comes down here. Is his position too large? Yeah, probably 33% of his portfolio, considering he has about 25% cash. If he hasn't taken some gains, maybe consider it. What he's asking about specifically, though, is he says he says he wants to sell some in-the-money call spreads as insurance, but he doesn't know what strike price or date. Here's another situation where you call your broker. If you're at Schwab or TD or another good broker, they have option specialists who can help you plan what kind of call spreads you want to do. If you want to sell out of the money upside calls naked, but against your stock, so it's not really naked, so it's covered calls. That's a nice income strategy. So you sort of trade around the core. But call your broker. That's what they're there for. Even though they're not making money off commissions anymore, they still like your nice balances on their books. So, and Neil is looking at a bunch of other stocks: Amazon, Microsoft, Google, Alibaba. Yeah, I think it's a great time to be looking at all those. Look at Square. Square's up 15% today as I record this on Monday. All right. So that's Neil. All right. Last portfolio I want to mention. Let's see if we can go back to my mug here. Stop sharing. All right. Brandon sent in a portfolio. I don't have time to look at his, but I want to mention two things. He asked about trading on margin. He's trading some margin. He's not sure what to do. And I'll say again, that's where you call your broker. Learn from your broker how to handle margin and if you should be using it for certain positions. He also owns the SOXL, SOXL, which is the 3 times bull ETF on the SOX index. And he's down 40%. He bought it at 130, was trading 80 when he sent his email last week. These are things you don't want to hold. You don't want to hold them for 40% losses. You have to decide if you don't get in at a good level and it's not working in 3 days or 3 weeks, you get out and wait for a better shot. They're not always going to come back. Now, in this case, it might, but I would be looking for Brandon to get rid of that Soxel on a relief rally here and then try it again lower. All right, that's it for my edition of Portfolio Makeover. We'll talk to you soon.
Coming up, Kevin Cook and Sheraz Mian with the Portfolio Makeover. But first, these interesting insights from Zacks Ultimate Editors.
This is Kevin Matras, and this is the Zacks Mailbag. So obviously the question on everybody's mind right now is the coronavirus and the bear market. So that will be the subject for this month. When will the coronavirus-induced bear market end, and when will the recovery begin? So as you know, on March 11th, the historic 11-year bull market, which showed no signs of slowing at the beginning of the year, was stopped in its tracks due to the coronavirus after closing more than 20% lower from its all-time highs just 4 weeks earlier. And it literally was the fastest bull market turn into a bear that we have ever seen before. Now, unlike previous bear markets, which are typically a result of a slowing economy, this one came about due to an unforeseen exogenous event. Prior to the outbreak, we arguably had the strongest economy of our lifetime. 50-year low unemployment, 20-year high in household income, near record high consumer confidence, and record high corporate profits. But of course, in an effort to slow the spread of the virus, the unprecedented containment measures that we enacted have temporarily shuttered businesses, keeping people inside, and that has wreaked havoc on our economy. If it can help save lives, obviously it's all going to be worth it. And once the worst is behind us, the economy and stocks are expected to soar as pent-up economic demand is unleashed. But again, at the moment, stocks are reacting to the shutdown. Now, in order to get a sense of when this bear market will end, it is good to look at past bear markets. So looking at the top 10 worst bear markets using the Dow following the Great Depression, it shows that it declines on average of 39.27%, and it lasts on average of 16.9 months. Now, for comparison, the Dow at its worst during this bear market was down by 38.37%. The S&P was down by 35.27%, and the NASDAQ was down by 32.45%. So not that far from the average. The rallies that follow bear markets, however, have been even bigger. Within a year after a bear market, stocks surge on average of 44.7%, and they go on to gain on average of 66.3% by year 3. If you were to go back to the recession of 2007-2009, the Great Recession, you'll see that the market then gained 63.4% in year 1, 100.6% by year 3, 153.6% by year 5, and more than 357% during the entire 11-plus year bull market that we had seen. Now, what's interesting, though, is that the Dow has literally already exited its bear market. After dropping as much as 38.37% at its lowest point, stocks then shot up by 21.3% over the next 3 days, officially exiting bear market territory on March 26th. All in all, the Dow's bear market literally lasted only 11 days. Again, shortest bear market we've seen, and it's now in a new bull market. Now, for the record, though, the S&P and the NASDAQ have not yet exited their bear market. The S&P only closed as high as 17.55% from their lowest close, and the NASDAQ only closed up 13.66%. But it's highly likely that those two benchmarks will eventually follow the Dow. And since the U.S. was in such a strong position going into this, it is likely to happen sooner rather than later. Now, over the next 2 weeks, everybody will be watching the outbreak as it's projected to reach its peak in the United States by mid-April. People will also be watching what's happening in Italy. As you know, they've had a severe outbreak. They are ahead of us by about 2 weeks, but since our initial curve mirrored theirs, we enacted strict social distancing measures in an effort to flatten our trajectory versus theirs. And aside from New York and New Jersey, it appears that it's working, that we are seeing that. Moreover, the rate of new cases in Italy is finally slowing. And that's great news for us, and it's why there is growing confidence that we will finally reach our peak while simultaneously avoiding the worst case scenario. And if that comes to pass, we could begin to start opening up our economy shortly thereafter. Some are even thinking as late as April. I'm thinking it's going to be as early as May. But either way, if we can get through this, we should be starting to see people talking about opening up the economy. Now, in the meantime, there's likely to be more volatility in the coming weeks and months. But now is the time to start building your list of dream stocks. You don't have to go all in at once, but you can start taking nibbles at these discounted prices. Some may go lower and some may not, but they are likely much lower now than where they were just a few short weeks ago, and much closer to the bottom if they haven't already hit it. Now, on the downside, I see support for all three of the major indexes at their gaps left on their charts from March 23rd. For the Dow, that comes in at 19,121.01. For the S&P, that's 2,300.73. And for the NASDAQ, that's 6984.94. Now, on the upside, as I said earlier, the Dow already exited their bear market and has technically entered a new bull. That doesn't mean they can't go lower, but it would be considered a bull market pullback. For the S&P, however, we need to see it close at or above 2684.88 for their bear market to end and a new bull to begin. For the NASDAQ, it's 8232.80. So set yourself an alert. When we close above those levels, it definitely will be cause to celebrate. But again, you want to be building your portfolio now. That's true for your favorite stocks as well as new stocks that you probably haven't even heard of yet. Because this virus outbreak and the upheavals it's brought about for businesses and consumers will usher in plenty of new and exciting opportunities in the inevitable bull market that follows. But again, it's important to remember that a large part of the recovery's gains typically happen at the very beginning, so you don't want to miss out. When the bear market ends and the inevitable bull market begins, that is when you want to make sure you are all in. People are calling this an opportunity of a lifetime, and I totally agree, because the rebound that's likely to follow is expected to be epic. So make sure you take full advantage of it.
Here are a few things you can expect to see coming up. Our mobile app includes features just for Zacks Ultimate members. In addition to having access to real-time pricing data from BATS, you can opt in to receive trade alert notifications and service updates for each portfolio you follow. Plus, be sure to check out the new Ultimate 4 Special Report, which was recently posted on the Zacks Ultimate homepage. And remember, the next Zacks Ultimate Strategy session will be posted in mid-May. So start thinking now of those submissions for the Zacks Mailbag and Portfolio Makeover segments.
Hi, this is Sheraz mian with the top stock pick. As you could see, my top stock pick is Dollar General. In this slide, we are showing the relative performance of Dollar General to the S&P 500. And as you could see, this is one of those few stocks that has successfully held its own, even though the market has lost about a fifth of its value. I see Dollar General as a beautiful blend of defense and growth. The defense side comes from the company's positioning to consumers trading down, which puts them in a position to benefit from this environment. The company has had an impressive growth profile over the last many years. It has had positive comp growth for 30 consecutive years, including the global financial crisis, and it has multiple sources of competitive advantages that makes its market positioning sustainable and also a lot more defensive and secured from online competitive pressures that has been an issue with many others in the space. I see Dollar General as a long-term holding, which has positive attributes and beneficial attributes that should benefit your portfolio, both for this environment of stressed out market conditions, and also in the during the stage when we are out of this. Management has come out with a number of new initiatives that should help margins, that should help sustain the growth profile. One valuable new initiative is the new store format, which gives them a visible runway for growth over the next many years. Management estimates that it essentially opens up the opportunity for 11,000 new units. The financial condition is very strong, which should be a concern and a key measure of health that you should be looking at any company during these times. You shouldn't worry on that front with Dollar General. Valuation isn't as mouth-watering as is generally all around in many other areas, but that is a function of how strong this company is and how well positioned it is for this type of environment. So an excellent play that gives you long-term combination of defense and growth. And that's the reason why I have been a fan of Dollar General for a long time, including these uncertain times.
Hello, I'm Jeremy Mullen, and I'm here today with your top pick of the day, which is Chewy.com. CHWI is the ticker. The stock is a Zacks #1 strong buy that sells pet food, pet supplies, and pet medications. It has a $14 billion market cap, and recently we have seen a positive catalyst for the company and the stock. We are having momentum to the online marketplaces with the stay-at-home and the lockdown orders. And I actually have a personal story about this where my vet told me to use Chewy.com. Basically, my dog has cancer, and we've been getting medications from my vet to help him out, and he's doing great on them. And when I went there to re-up, they said, this is your last one. We have to save our stock for in-house patients only. So they said, what should I do? They said, go to Chewy.com, go to some other pet online retailer, and get your medications from them. I'm like, I know Chewy. They IPO'd last year. I've been following the stock a little bit, but let's check them out. So I go online, check them out, order my meds, see that food prices are pretty cheap, treats. I got a whole bunch of stuff, came quickly, and I thought, wow, this is a green light for me. I got to look into this stock. So I like what they are putting out there as far as earnings. They reported last week, 2-cent beat, revenue guide higher, 150 to 152 versus the 145 expected. So they're already starting to see momentum in earnings. Net sales are up 7.8% year after year. Looking further at the fundamentals of the industry, we see that pet food saw 37 billion sold in 2019 with vet care at 29 billion. So there's a lot of money to be made in this area. And I also put a quote up from the CEO. It's just a genuine quote saying, showing how they're going to get through this time period. And the bottom half of this is great. We are here 24/7 caring for the safety and well-being of our team members and meeting the shop-at-home needs of our customers, staying true to our mission of being the most trusted and convenient online destination for pet parents everywhere. I love that. I love their mission. They're going to be here for us as long as we have to stay inside. And it's going to create this customer loyalty. When this whole thing is over, people are going to stick around. And what I like about this whole momentum and this catalyst is there's a large short position, 28% of the float. So as this catalyst is realized, we're going to see price momentum go higher. And let's look at that. Let's look at the technicals. We're above all moving averages. We had a pullback from my first fib target of 39.60, and I think we can buy it now. I'm looking for 29.50, 31 for entry, but we might not get it. And my long-term target is $51. Now, looking at the chart, we can see how it's chopped around the last 6 months between the low 20s as support and the high 20s as resistance. We saw that puke down in March with the rest of the market and a quick snap back when people realized, oh man, people are buying Chewy. So this stock has actually gone up while everything else has gone down. You can see the green line is a 21. The blue line is the 50-day moving averages. We're well above both of those. We hit my fib target of 161.8 and pulled back. I think you can buy it here between 35 and 30. Build a position for a longer-term target of $51 by the end of the year. And that's what I got for Chewy. Thank you very much. I'm Jeremy Mullen, and that's today's top stock pick.